Welcome to the latest edition of the Real Estate Luminaries series at the McDonough School of Business. My name is Hannah Steckler. I'm an MBA program alumni, and I currently work at Eastdil Secured in their real estate investment banking group here in DC. Given the level of investor interest in the industrial real estate sector today and over time, we have doubled down on the subject this year. And with both the panel and our Luminaries conversation, we are focused on this property type. I couldn't be more excited to introduce the lineup we'll hear from tonight, especially Hamid Mokarram, CEO of Prologis. We are very proud of this event, as it is our annual gathering on campus that allows us to highlight the strength of the real estate program at McDonough. It's also an opportunity for all of us to come together as a real estate community, inclusive of students, alumni, parents, and friends of the program. We're so thankful to have you join us here for this evening's event. I'd like to say thank you to HFF, who is our lead sponsor this year. Thank you also to Cytex for sponsoring our cocktail reception. I'd also like to thank our Hoya Corporate Cornerstone members, Avalon Bay, Hilton, Host Hotels and Resorts, the RLJ Companies, Green Oak, Goldman Sachs, Joss Realty, UDR, and Vornado. We appreciate your support. We've received feedback in the past that we need to get on with the show, so let's get to it. I'll quickly turn it over to Matt Seifer and Lena Duffield, who will be talking us through our panel discussion. Thank you, and enjoy the event.
All right, can everybody hear me out there? All right, we having a good night tonight? All right. Well, we certainly appreciate everybody being here. This is the highlight of our year every year, and we always have what I think is a very good show, principally because we have outstanding people speaking here today, and certainly this year is no different. So my name is Matt Seifer. I'm the director of the Real Estate Center here, the Steers Center for Global Real Estate at Georgetown University. I'm thrilled to be here. In this panel, as we've talked about by Hannah, we're doubling down on industrial this year. So we've got the private side, which is essentially what we have assembled before us, and then we'll have the public conversation a little bit later here after this. So what I thought I could do is I'm going to introduce, first of all, my co-moderator by the name of Lena Duffield, who is an undergrad alum of the Business School 2017. She was one of my very, very good students, maybe my best student, actually, in Finance 220 for those that are in the classroom. So I'm thrilled you're here. She was at Morgan Stanley, or is at Morgan Stanley Real Assets until she moves to Wheelock at some point this summer. So Lena, thank you very much for being here. And I'm going to introduce very quickly. I'm not a big reader of bios because I think everybody can do that. So we're going to cut to the chase. We have Eric Frankel here, who's the lead analyst covering industrial, self-storage, and towers at Green Street Advisors, what I think produces some of the best research in the world. To his left is Michael Gershenson. So Gersh, as he is known to his friends, is a managing director focused on U.S. real estate opportunities, covering principally New York and Boston. To his left is my good friend Bill Grubbs, who I met when I first started at Invesco. In fact, we started within days of each other in 2005. At that point, Bill came to manage the core fund, which we were just starting at that point in time. And I think he's the longest tenured core fund manager that is in existence today, so to speak. Yeah. But as of right now, he's also over all of funds management at Invesco, including their value add funds. So, and to his left, Brian Milberg. So both Brian and Michael are both undergrad alums, 2000 of the business school. So Brian is a co-founder of the Cytex Group, which he founded with a partner in 2010, and he's the senior partner there after a career at KTR. So that's the panel, and we're going to get started with Lena in the first question, and if you can lead us through, please.
All right, thank you, Matt. So Eric, it might be the fact that your research makes my job a lot easier, or the fact that Mike Kirby's son is a Hoya, but Matt and I think very highly of Green Street and all the research that you produce. So given that you're the sole research professional on the panel today, we thought we could start with you and ask you to paint a bit of a top-down picture for us and the audience to frame today's discussion. So could you kick us off by talking a little bit about the industrial market broadly today?
Sure. So first, let me just say Mike Kirby, whose son went here, he's normally a very even keel guy, but when he heard I was participating, he was he actually raised his voice a little bit. So I think that should indicate his excitement level. So I'll sure to relay how great the audience looks today. In terms of our outlook, so we generally subscribe to a new normal outlook. So GDP growth is basically going to be 2% plus or minus for a long period of time, save a recession. It's just the general structure of our economy at this point. So, and plus the fiscal and stimulus and the tax cut from last year. So with that, you're going to have, retail sales growth in the low single digits, trade growth in the low to mid single digits at best. And so in that environment, you'd expect demand for the top 50 industrial markets to produce maybe 180, 190 million square feet of net absorption per year. Over the last 4 years, it's been most closer to 250 to 260 million square feet. And it probably could have been even higher if there was actually more available supply in certain markets. So this is all just due to the reconfiguration of supply chains that e-commerce is causing. So it's really changed the way that goods are distributed, and the location of the warehouses as well has also been really quite amazing. So this demand boost is just, it's had a lot of reverberating effects, but you've had asset values growing. They are now at least 70, 80% above peak levels in a lot of markets. Obviously, investor activity has been quite strong, and in the supply, and from a supply perspective, what's really been surprising is that usually this has been a somewhat low barrier to entry business. So as soon as a business park and a certain exit of a highway gets filled up, you go to the next exit and you build up that part of an interstate highway. But what's happened this cycle is that because proximity to people for both transportation cost purposes and labor purposes is so important, tenants are a lot more discriminating when it comes to that. And so you've seen a lot more demand in really densely populated areas like Southern California, New Jersey, the Bay Area, Seattle, where the economies are also relatively robust. And so when you have industrial that's not the highest and best use of real estate, it's been really hard to find property, to find ways to build. And so when you have that kind of environment, you get these big rent spikes. And so that's the environment we're seeing. It's been a real surprise. I did not expect this to happen 3 or 4 years ago, but now it seems like this is going to be the new normal of industrial for a while.
So on that, Eric, while we're talking about kind of the fundamental side, I mean, a lot of the property value increases are largely due to NOI growth. So from a capital markets sort of appetite perspective and the proxy being cap rates, I mean, what do you view sort of the cap rate future like with industrial?
Yeah, well, cap rates have they keep compressing, and a lot of that is due to NOI growth. But I will say that generally with commercial real estate, private market investors, from our view, are solving for essentially a 6% IRR if they hold it for a very long period of time. So for industrial at this point, you're basically, if you're buying a broad national portfolio, you're paying a sub 5% cap rate, and you're expecting for your NOI growth to be really solid. We call it 4 to 5% over the next 5 years, and then over the long term, obviously, it should temper a little bit. But that's generally the math. And so with the asset class too, is that while there is a pretty high wall of capital that's available to invest in commercial real estate, it's a lot more discriminating than it used to be. So there's certain asset classes, retail in particular, that are pretty redlined. In office, I think investors are a lot more focused than they used to be. And generally, industrial and apartments are still pretty red hot, and you probably there's probably the panelists here can describe this in more detail. But you probably get a little more better sign off to invest in that type of to invest in industrial, and so the flood of capital has been quite amazing, and so that's why you see cap rates probably continue to compress a little bit, just because potentially return expectations are lowering too. So we got the researcher, so we got the private equity guy, so we got the institutional guy that's in a core fund, sort of principally, but over the value fund stuff too, and then we have the developer. So on the private equity and sort of the institutional capital, can you both talk a little bit about just, and we'll start with Michael, but just the challenges you're experiencing in just identifying product and what sort of lengths you're going to identify product?
Sure. So we coming out of the recession, we thought that we'd be able to buy vacant warehouses, and we'd be able to buy them for a decent price, and therefore we'd be able to make opportunistic returns by taking the risk that we would be able to lease them in a short period of time. And our hold period is usually 3 to 5 years, and we want to make opportunistic returns to us, which is 20 plus IRRs. And we found out after the first 3 situations that people were already bidding up existing warehouses. So I would say that for the past 6 years, we haven't looked at a single existing warehouse because we can't make the numbers work. What we have been able to do is provide equity to developers like Brian to do spec developments. And the math actually is, Eric already provided for you, which is if we can get to a 6% yield on cost, I can sell that facility for a 4.5 cap rate. That's the average cap rate across the U.S. as it relates to major markets and Class A stuff. So what we'll do is we'll try and we'll try and know our markets better than everybody else, try and be close to all the developers, and understand where we're going to have opportunities to provide equity capital to somebody who wants to be a merchant builder, because we're going to want to build the facility, lease it, and then sell it. And if we can do that and we can get 150 basis point spread yield on cost, we should be able to make our returns within the time frame I described.
So Bill, real quick before we get to you, or now, but in the core fund, you've got a value add bucket, and the whole point of the value add bucket is where you can do development and sort of the higher returning stuff. Can you talk about the value add bucket in the context of the industrial?
Sure, absolutely. I think industrial, so running a U.S. core fund that has a benchmark, which is the Odyssey Index, and so it's very transparent, very competitive. Industrial is about 15% of that index. And industrial has been the equivalent of like the FANG stocks in the index. If you don't own it or enough of it, you're underperforming. So getting your exposure and keeping up with the index has been a real challenge. We started coming out of the financial crisis. The biggest, we looked at each property sector and took believe like Eric, there's going to be overall slower growth in the country, and more importantly, it's going to be less evenly shared than it's ever been. Not that it was ever evenly shared. There's going to be bigger differences between winners and losers. And in industrial, the simple explanation is focusing, particularly for a core fund that's going to have long-term investment in these assets, that wants a durable and growing income, investing in major markets that have major seaports and/or airports, immediate proximity to large and growing population centers, and then multi-building concentrations in those markets. So a very disciplined strategy. Now, the problem is we should have not been so disciplined. We should have closed, should have said to the acquisition team, just like, I don't care what it looks like. I don't know if you care if you duck to get in, buy it. Like starting in like 2012, just buy everything you can, because the cap rate compression has been dramatic. And fundamentals, look, the only fundamentals are returns that compete with industrial in that world, that Odyssey world, is a limited number of tech office markets, Austin, San Francisco, Seattle. They're the only ones who can compare in the last 3 to 5 years the returns that industrial has given. So today we have built, we've bought, we've taken lease up risk in the core fund, we've built. And look, the great thing about building in a core fund is, like when I show up, everyone smiles. I'm the lowest cost of capital, typically, and so, or one of them. But we've been able to build, and we built in the Inland early on, and take lease up risk. But today, I think the challenge is, core spreads are way down. So looking at those markets that I want to describe that are going to have long-term durability and not just difficult, lots of supply, and I think that's broader than it used to be. But the cap rates in major coastal markets are 4 or less in many places, and development spreads. We have 2 big projects, one at the Burbank Airport, 1.5 million square feet, and one in Fremont, California, 1.8 million square feet that we've owned the land for a while. And to commit to those today, the yield on cost would be in the mid-4s, maybe a 50 basis point development spread. And that's just, so the point is, we've done all those things today, right now as it stands today, given the demand, whether it's buying core, taking lease up risk, or development, for a long-term, a build-to-core strategy is, I'm kind of dumbfounded a little bit. And so now on the value side, where you can build and sell, I think there's a lot broader universe that you can do. So it's a challenge.
So Michael and Bill, with so much competition for deals out there, how do you distinguish yourselves as a source of capital?
You want to go first?
Well, I think sure. I think it's knowing what you're looking. There's a lot of who we are as a firm, knowing what you're looking for, and being a reliable buyer, and that starts with focusing on what you're looking for, not wasting people's time, and having the relationships in the process to be a reliable source of capital, cycle in, cycle out. And whether it's our core fund or our value funds or a separate account, having multiple capital sources that if one is off the sidelines, we still can bring capital to the table. So that has been, there's not rocket science, it's just doing what you say you can do and doing it in an expedient, logical, consistent manner. And the waterfalls and the promote structures, obviously industrial have come in just like pricing, and we don't create the market, so if we want to have it, we have to meet the market on those things, but be the buyer of choice.
Yeah, I agree with everything that he said. I think the one thing that we do that might be a little bit different because of the fact that we're basically looking at development at this point is that we will enter into transactions before it's completely buttoned up. We'll take a pre-development budget and split that with the developer 50-50 so that we're taking a little bit of the risk along the way. And developers like laying off risk. So if we're willing to be there for them during that portion of the project, then we've been able to get our hands on some pretty interesting
And I
opportunities.
think that's pretty consistent. You have to do that to access things these days.
Yeah.
So Brian, we're going to come to you now. So as the developer here, the operator, you're probably the most attractive guy in the whole place here.
I just for the first time realized why it's so hard now to find a deal because of everything that's happening.
But everybody, I would assume, is trying to get capital with you, right? I mean, everybody wants, given the success that you've had at Sitex, it's, I'm sure any number of people would be happy to give you their LP capital. So, can you get us started? I know Lena's got a bunch of questions on more the bottom up from you, but just your view of just, the conundrum of being able to find opportunities today.
Yeah, I mean, our strategy has always been very street level, and if you go back, I mean, this business more so than most, especially when things get very difficult, whether it's identifying opportunities, is very relationship driven, and what has changed the dynamic between operator developer. And equity is what we're seeing now is we're actually getting phone calls from guys like Gersh where they see a deal through a relationship they have, and their relationship through Carlisle is spread much further than Sitex, who's in two or three markets. They'll see a deal, they'll call us up and say, come do this with us as the industrial expert. Historically, it was us always going out, running the streets, knocking on doors, meeting with owners, cultivating those relationships, and then looking for the equity once we've identified a transaction. So it speaks to the demand today and the allocations that these funds have to get out into industrial. The reason why I originally got into industrial is because nobody knew what it was. Up until 3 years ago, if I was at a dinner, people would ask what I did, and they said, "Oh, so you convert artists' lofts to buildings?" I don't know exactly what you do. And today, you're at a dinner, and everyone's, "Oh yeah, last mile, e-commerce, distribution, Amazon." You think of that, and then you also look at the learning curve that these funds had to do to get brought up quickly in a sector where it sounds simple, but when you think of it, you need to understand logistics and how products move to the consumer and from the port and from how they get to the homes and the stores. And then on top of all that, you have a real fundamental shift in the sector because of what's happening with e-commerce and retail going into buildings. So that learning curve happened over the past, I would say, 2.5 years, and all of a sudden, everybody wants to get into industrial. The floodgates have opened with capital. The floodgates have opened with debt. And it's become incredibly competitive.
So on the tenant side of things, what are the top 3 things that you see tenants demanding today, and how have you changed your development strategy to accommodate those demands?
Tenants today, our strategy is very infill. So we are really within, call it a 30 to 40 mile radius of the major populations. And that tenant, the typical size is 30 to 100,000 square foot tenant. What the sophisticated e-commerce users today care more about car parking because they are labor-intensive operations that close in, where when I say clear heights, ceiling heights in buildings and the amount of loading docks you had per square foot were really important before this e-commerce really came into effect. Now these last mile users, they need car parking because the labor isn't so much manufacturing anymore, but it's, I need to put a box together that's going to a house, and I need to pick things off a shelf, then put them in my van, and then drive them to that customer's house. So what's amazed us is you almost need a 2 to 1 ratio of surface lot to building square footage, when that never really existed infill, to the point where some tenants are actually taking 2 buildings next to each other, tearing one down for parking, and keeping the other building. And what's starting to happen in the industrial sector, certainly in New York, New Jersey, and Southern California, is tenants now are actually willing to pay you rent on surface parking. It's half of typically what your building rent is, but you're now getting income on your parking lots, which has never happened before. And that's another reason why your price per square foot are also increasing substantially.
So to follow up on that and talk a little bit more about demand for infill product, Prologis actually recently built the first multi-level industrial warehouse in the United States. And there's actually several New York City area developers planning similar projects. So do you view this strategy as widely replicable and scalable? And if so, from what type of user do you see demand for this multi-level space?
It's something that gets debated every day. What's unique about the environment right now is every new deal is a new comp. And when I say a new comp, certainly in the infill markets, because supply is so limited and demand is so strong right now, every new lease deal that's happening is a new high rent. So, and then people are buying off of that 1 or 2, data points. So you have these multi-story buildings now that, quite frankly, office developers are getting into in New York City, and they're buying up 8 to 15 acre sites in New York City. They're building multi-story. They're building buildings that haven't been seen before other than on the West Coast with Prologis. They're asking rents that have never been seen before, but it doesn't mean it's not going to happen because there's so much demand. I think, being a developer, I would love to see it happen. So where our business strategy is always take a little bit of a backseat. You don't need to be the first person in, but if the momentum starts and there are tenants that start taking these spaces, it's okay to be next in. But there is a lot of capital chasing these new buildings that really haven't been seen before. In New York City alone, there's probably $1 billion worth of projects just in the pipeline that are going to get developed over the next 18 to 24 months for product that's never been seen before on the East Coast.
So I'm going to come to Bill real quick. So, Bill, I remember when we were at Invesco, we always struggled with our industrial performance, just sort of looking at what's the driver of performance and how do we improve our performance. And, one of the things I think we kind of looked at is that the stuff that's coming to market that's built, leased, it's coming to market for a reason, right? And so how do you, the product that is, being sold as built, is it any good? I mean, is that product you'd want to own, or we kind of looked at development as really the best route to good performance because everybody that has good product doesn't want to sell it, and the stuff that's coming out is coming out for a reason.
Well, I think that has always been a version of that. I think today it's particularly acute, and because to the point, the fundamentals are strong. People who own, particularly in the markets you want to be in, are not selling typically. It's a lot of build to own. And so our view is I never wanted the next building up the interstate, the one-off building at the next exit that, you do a 10-year lease with Procter & Gamble, and then when that 10 years is up, they're over market and they either roll down or they leave and go to the next exit up the interstate. So I think I think if you want to sell industrial, this is stating the obvious, an awesome time to sell industrial. There's just not very few transactions, particularly of manageable size. And when, there's 3 recent deals I can think of, 2 in Seattle that both, I think, do awesome assets near SeaTac, went for a 3.65 cap rate. A Denver deal that we just chased went for 15-20% over the initial bids. And so, but I don't know if you want to buy in Columbus, for example. I'm not sure, because maybe we should be, but we haven't. But even there, I think even the higher cap rate markets, that higher cap rate is still a lot lower than it was 36 months ago relative to that market. So I think there, if you want to sell in Kansas City or Columbus, anywhere is the time to sell. But
So I'm going to come back to you, Eric, and I'm going to turn over to Lena too. But what do you make of sort of the industry or the investor appetite for industrial in the light of like the IDI portfolio sale and the industrial property trust portfolio? I mean, what are you thinking just from a research side as you look at the investor sort of appetite here?
This is probably the easiest time to sell any portfolio worth less than $15 billion in history, to put it simply. No, there's just a lot of demand.
Yeah.
Anything that's more seriously, anything that's reasonably well put together will get a bid. There's a lot of capital. Like I said, it's more discerning and it's more disciplined than you would think. It's not chasing every single type of U.S. Real estate asset, but industrial, if it's reasonably well managed and well packaged and marketed, IPT, which is on the market now, IDI just sold. If I had to guess, I cover 6 industrial REITs now that are of reasonable size. I wouldn't be surprised if I was covering fewer next year, just because there's enough appetite for private for institutional capital to take out our REITs. So we'll see.
A comment on that. We cover every asset class at Carlyle, and there's only 2 asset classes that we think that there's a portfolio premium if you can aggregate assets, and it's self-storage and industrial.
So in the search for yield, we've talked about how difficult it is to find assets that are priced attractively. In the search for yield, there appears to be more interest now in more esoteric subsectors of industrial, like cold storage, for example. So, broadly, this is something everyone can address. Are you all looking at this, and just what are your general thoughts on this trend?
I could go first. That's fine. So there's a cold storage real estate company called Americold that went public last year. So I think it's public knowledge that our advisory team helped them to structure their company before they went public. And so the cold storage businesses are very interesting. They've had a very choppy track record over a long period of time. The big difference is that they're operating businesses. It's not real estate. So any industrial property you buy, even if it's net leased, then you're generally getting a 70% profit margin, your NOI divided by revenue. For a fully serviced cold storage property, your operating margins are closer to 30%. It acts more like a hotel. And so it's a lot more volatile. You have to worry a lot more about expenses. Your demand, depending on the type of food you're selling, can fluctuate a good bit. And then in the last 15, 20 years, there's also kind of this financial engineering that occurred. So there was another REIT that owned Americold actually at one point, but they separated into an OpCo and PropCo structure. And so the operation was just managed, candidly, not all that well. And so it's had a really tough history. What's happened now, though, is I think the platforms that are getting put together, there's another large company called Lineage Logistics that's now bigger than Americold. But those are the 2 largest cold storage companies. And what you're seeing is that they're just being better operators. They're using technology. They're taking advantage of their scale. So they're more reputable business. They're more reputable businesses. There's not that much cold storage supply that's getting built. And so there's a lot of momentum related to it. I think there's a thesis that e-commerce sale penetration is going to grow in grocery. I'm a little bit more skeptical of that, but you kind of take all these variables, and that's why there's interest. But it does act quite differently than industrial real estate. So the CapEx profile is also a little bit higher. There's obsolescence, too, just because of cold storage. You have to replace all the equipment every 20, 30 years in facilities. So I think it's drafting off all this euphoria we're seeing, but I think, it requires, some caution.
So Brian, kind of maybe staying along the lines with that, with Amazon and this last mile stuff, there's a lot of conversation about, industrial being embedded within cities, kind of smaller scale, sort of the last, literally like last mile distribution, which is different from the big bombers out on the interstate. Can you talk a little bit about how your firm's thinking about more of the product that's sort of embedded in cities?
Yeah, I mean, I think it's twofold. We are, what's happening right now for guys like us is because we're so focused at the street level that we go after everything, and our average deal could take 3 years. I have something that I've had under contract for 7 years. So it takes a while with our business model to get to the real estate. What's interesting is the New Jersey market is 1 billion square feet of product. I'm just using New Jersey as an example because as soon as a press release came out, somebody bought a building in the boroughs, all of a sudden you now have 500 sources of equity that want to buy in the boroughs of New York City. The entire New York City industrial market that you would actually want to play ball in from an inventory standpoint is half the size of one of the small major submarkets within New Jersey. So you're talking maybe 40 million square feet of product. Of that 40 million square feet of product, a good percentage of in the boroughs is actually owner-occupied. The stuff that's owner-occupied that you would really want to own, people typically aren't sellers because they can't replace that real estate because their workers are there, they're making local deliveries. So all we're doing is cultivating those relationships. There will be a day that they sell, whether it's in this cycle or the next, but that you have to be incredibly patient, incredibly disciplined to go out and acquire those assets. The shift for us in terms of sourcing opportunities is the pension funds, the Carlyles. They're now willing to buy that $5 million deal one-off, that $10 million deal one-off, because the industrial sector from a price per square foot never had sex appeal to the bigger companies because you had to acquire so much of it to get to mass. And $1 billion fund isn't going to go buy a $5 million piece of real estate. Today they are because it's industrial. So we're now in a world where we're competing with institutional capital, and we try to use that to our advantage because we can move quicker, we don't have investment committees, and that also helps us get over the hump where we could say, okay, we can sit in a room, we can get a deal agreed to, we can close in 30 days. And typically the guys that are selling need that type of momentum to get a deal done.
So Brian, I'm going to ask you one more question. I'm going to turn it over to Lena. So the Red Hook deal that you guys did and sold recently made a lot of press, and the Urban Land Institute has made a big deal out of it, as they should. So can you talk about that transaction a little bit? Can you sort of explain it from your perspective, the tenant's perspective, and why it was such a successful investment for you all?
Yeah, we had been looking in the boroughs for a long time to find the right opportunity. We were brought to this site through a relationship. It was a 14-acre waterfront site in Red Hook, and when you stand there, it was the original Daily News press plant. And when you stand on the roof of this building, you're telling yourself there is no way this is an industrial site. This has to be residential. It has to be something else. The group that had assembled the sites, there were 6 different parcels that a group had assembled over about 7 years. They were in a situation where they had to get out of this property to take care of another asset. And they were marketing it with these incredible, elaborate plans for a creative office complex, mixed use. Because we had been looking in the boroughs properties we had looked at, and we had looked at most of the inventory, were just not good functional product. Street loading, very tight truck courts, low ceiling heights. I walked up to this property with my team and we looked at this and said, this is some of the best functional product we've seen in the boroughs. And at the time, this was right before anybody really had started being active in the boroughs. But the property made sense to us because there was a lot of trailer parking. The functionality of the actual warehouses was the best we had seen in the boroughs. So we started underwriting it, and we put rents to it that we kind of knew were taking rents in the boroughs, and the deal didn't even come close to being underwritten properly. We were so short on pro forma, I think we were barely breaking even on an exit. So we just kept pushing rents a little bit, and then we started meeting with some of the big tenants in the market. And the more that we investigated, the more we dug in, we just kept pushing rents a little bit more and a little bit more until we got to a price that we felt comfortable with and we felt we could get, given where the debt was on the property. And we ended up closing on the property, and subsequently we found out right after we closed it, two major companies, one being UPS, who's the tenant now, were in the market for large sites. And what's interesting is UPS ended up taking the entire property. And we sat down with them and asked them, why this property? And the answer they gave was they were thinking bigger picture, but I'm sure most of you have read congestion pricing is going to be hitting Manhattan. The cost of getting goods into the city is, it's larger, it's higher than it's ever been. It's got some of the I think it's the highest minimum wage in the United States. So the cost of doing business in New York City is incredibly expensive. And their future plans for that property to barge goods directly from the port across the river to this site, where they would cut out all of their long-haul containers and then just have local delivery to Brooklyn and to the population from this property. So again, if you look at that, not anything we were thinking when we acquired the property, but it makes a lot of sense.
Selena, before you ask yours, I just want to make mention, so if you have questions, you have to tweet them using the hashtag SteersGlobal, and I'll be managing that here. Selena, I'm going to turn it back over to you.
All right. So this is for everybody can answer, but Brian actually might be the closest to this one. But how have rising construction costs impacted your investment strategies? And in your opinion, what's driving these increases? What factors are most important?
God, the biggest increase in cost for us has been land. Construction pricing has gone up steadily, but when you're building buildings and the land costs more than you're building, which is what's happened now, it's very hard to swallow. I've been buying and developing industrial buildings for almost 20 years, and the cost of a new building is 3.5 times what it was when I first got into this business. So that's the toughest part to swallow. And the other piece, everyone says, again, I'm speaking to infill markets, there's no land for big box development. What's happening now, because rents have gotten to a point and yields have gotten low enough where you can actually make sense of cleaning up incredibly contaminated sites, because it's just now a cost of the project, and now it makes sense to go buy that big piece of property that everybody said can never be developed, and now all of a sudden there's a 1 million square foot building where nobody thought one could be built. So that dynamic is happening. Again, I'm going to keep, I don't want to be too micro, but I'm speaking to New Jersey because it's our backyard, but between the Holland Tunnel and the George Washington Bridge, there hasn't been big box development there for I don't know how long. And there's a plethora of, contaminated sites. And, fast forward to today, there's going to be almost 12 million square feet of spec development right outside of New York City that's getting built, that's all coming out of the ground in the next 3 years. So it's only because the rents and the low yields now that people are underwriting to can afford it.
I think two examples are our Pacific Commons site in Fremont and our Avion Burbank, where our land base, we've owned the land for 3 years, and our yield on costs on those were just shy of 6. And on today's land price and starting construction today, that yield on costs would be mid-4s in 2.5 years.
So a question from, a question from the crowd here, and so maybe this goes to Brian more than anybody, but so if you have dark big boxes, retail boxes, right? So we're trying to figure out what to do with malls and things like that. They're usually well positioned from a highway perspective and things along those lines. Any play for industrial there?
I have a hard time seeing cities, make a warehouse out of the Best Buy. I don't think there are a lot of cities that are going to go for that personally. But
I agree. Yeah. It's funny though, because a lot of these older infill industrial areas, a lot of the big box retail are former warehouses. So some of the zoning still exists, certainly in the boroughs. There's definitely a lot of demand right now. There's a couple Sears stores specifically in great locations that industrial developers are looking at. The biggest rub right now are the municipalities and not wanting industrial. I think what has to be sold eventually is If you convert this to industrial, it reduces your weekend traffic count when people are home, and when people get home from work at night, you're not going to have any cars clouding the streets because the retail is no longer there, and most of the industrial hours are during the day, and they're typically not on weekends locally. So I think that argument is going to take a lot of time because people think trucks, people think dirty. But I could tell you I've been hung up on a bunch by mall owners, but when I give them industrial valuations, and it's 10% of what their debt is. So that's going to be tough.
They said we'll build multi.
Right.
The biggest challenge is industrial is usually not the highest and best use, especially if it's good real estate in a major metropolitan area. That's always going to be the big challenge. So there's been a lot more self-storage conversion, actually, of dead boxes than industrial over the last few years.
Or you scrape it, it's multifamily.
Yep.
Yeah.
So related, and maybe more to Brian and then to Michael a little bit, but so the opportunity zone sort of concept, is that playing at all in anything you guys are thinking about today?
Hearing a lot about it.
Yeah, I mean, for what we do, our capital just doesn't fit in with the opportunity zone concept. I mean, we do a lot of development, but we want to sell within 3 to 5 years. You don't get any tax benefits unless you're holding for 7 or 10 years. So we don't fit really well with it, and we're having a hard time understanding how you're going to make a lot of money setting up a separate fund just to do it.
Yeah, we've been to conferences, we've spoken to attorneys that claim they had part in writing the legislation. To Gersh's point, I think it's got to be, it's probably a perfect alignment with a family office that's thinking long-term, that has sales that are happening now. But there are a lot of unanswered questions. The biggest one is what happens to any type of outflow of dollars during your hold period in the opportunity fund. That is either cash flow, refinancing, or recapitalizing the deal, either with another opportunity fund. But our understanding is, and based on a plethora of people we've spoken with, you can't pull money out of the opportunity fund during the hold period. So if you really analyze your opportunity costs of the dollars that are in that transaction, you're much better off just paying the government's taxes and collecting cash flow over that 10-year period and reinvesting it somewhere else.
My bigger concern on opportunity funds is a lot of money will be invested that shouldn't be invested based on tax reasons and create a lot of supply, whether it's multifamily or apartments or industrial, that we just don't need.
Sounds like the 80s? Something
Similar,
along those lines?
yeah.
So, Selena, I'm going to ask one and I'm going to come to you, okay? So, from the crowd here, when we think about some of the faster growing smaller cities like Charlotte, for instance, and the like, what's the opportunity there? And with capital, outside of New York, we all understand that, but what about investing in industrial outside of some of these rapidly growing smaller cities? Is that so? To our capital sources here, is that on your list?
Yeah, so for us, it's we stick to the main industrial hubs. We're Dallas, Houston, Atlanta, Jersey, Southern California, maybe DC. Because of our strategy, we want to make sure that there's maximum liquidity. And in our opinion, the types of markets you're talking about, if there is a hiccup of any kind, that's the first place that liquidity is going to start drying up.
On the industrial side, I think it's similar. For the core fund in particular, for build and own, it's sticking very similar to that. Denver would be another city we'd look at on the industrial side for the core fund, but then on the value side, a little broader. I think there is opportunity right now. Charlotte, for example, would be a good example. But how durable, but your exit is, does the window shut is the question.
Yeah.
So we've heard a lot today about how e-commerce has increased demand for industrial space. But in all of your opinions, is the rise of e-commerce increasing industrial demand overall, or is it simply shifting demand for space that would have materialized from traditional retailers in an economic expansion from traditional users to e-commerce users? That's probably more of an Eric question.
Oh, no, it's a big boost.
It's a big boost.
Yeah, just the act of breaking down a pallet, so usually goods are stored together in big clumps, and so that it's a pallet of goods. If you go to any warehouse, you'll see that. And the traditional ways, you just see your rack, you have your racks that go up to the ceiling and you have 6 rows of pallets essentially to store goods. And so what's really, I mean, the use inside of warehouses in both the middle of the country and coastal and all these, in these densely populated markets has changed. There's a lot more sorting that's occurring. And so that sorting process, it's really what's driving the big demand boost. And so, one thing I'm trying to look into now is how automation and robotics might make that a little bit more efficient, but it's just a multiplier effect. And then you have reverse logistics too, so returns are a lot easier as well. So it's definitely more costly. You guys can probably comment better than I can about the cost of tenant build-outs. I think there's a lot more infrastructure that's in these fulfillment centers today than there were. It requires a lot more space than it used to.
So I'm going to ask one more question, and then we should go to the student questions to wrap things up here. So I'm going to assume that the debt markets are wide open on this stuff, just like the equity side. So, and just any comments on the debt availability, maybe Michael or?
Yeah, I mean, 65% non-recourse financing at sub 250 rates all day long for development.
Yeah, there's no shortage of debt.
There you go. Yeah. All right, Lena, why don't you close us out with a couple student-related questions here for us?
Yeah, we wanted to close out with some things that were, bits of advice that might be more relevant to the students in the audience. So I think the first question to start off is, what skills do you value most in your entry-level employees? And what skills do you think are the most valuable for success in your first job?
Bill, go.
Well, I think it's relational and communication skills. I mean, it's obviously a hard work ethic and curiosity but sense of urgency. But it's that ability to relate and communicate to people. I think, no question.
I would say a certain level of grit, I think, is definitely needed. You're gonna, I think you're probably faced more adversity in your professional life than you probably have in your college career. Obviously, you're all very accomplished students, and that's awesome. But work life is different. So when you're given an assignment, stick it out and do the best you can. If you have to stay a couple hours late to do that, so be it. But usually that tends to get you ahead.
Yeah, I mean, I would echo what's already been spoken earlier. I mean, for us as a finance shop, a pretty strong modeling skill set is pretty important. But I think that what these gentlemen have said as it relates to the interpersonal skills, the ability to communicate, the ability to show a drive is really critical.
The one thing I can say is don't do your work to get it done. Do your work to learn from it and make that work better and show initiative. It's easy to just get a task and just be done and then turn it over. But taking that task and turning it into something that's more productive will separate you from the rest.
And I think one of the greatest things about this business is the relational side. Big companies, you go to work for Google or, the relations inside your company are important, but what really moves you in this business is the relationships outside your companies as well. And that drives the business, I think, as much as the numbers. And that's, I think, it's pretty unique to the magnitude of that in the real estate business, and that is the best thing that I enjoy.
Great, well, thank you. And finally, to finish this out, what is the number one piece of advice that you would offer students and young professionals today? Maybe something you wish that you had known when you were sitting in these seats.
We'll just go down the line. Franco, we can start with you.
The world changes, adapt.
Wow. I don't know if mine's going to be quite as deep. I would say every time you have an opportunity to interact with folks like the folks that are in this room, show up, take initiative, and try and learn something.
Bill.
Yeah, be creative.
Yeah, I was going to say, just think on your own.
Yeah.
If you think on your own, everyone in the room is smart, and if you use that and you provide and you show people around you that you're smart and thoughtful, it goes a long way.
Great. Well, Lena, great job. Thank you so much for being here. Thank you to the panelists. Great job. Can you join me in thanking everybody here, please?